Biggest silver drop in 10 years. What traders must know now. If you've been following the silver market recently, you already know that something extraordinary has happened. March 2026 delivered one of the sharpest declines silver has seen in over a decade. Prices didn't just pull back, they dropped aggressively, wiping out weeks of gains in a matter of days. For traders, this kind of move is both dangerous and full of opportunity. But to navigate it properly, you need to understand exactly what caused it and what it means for what comes next. Just a short time ago, silver was trading at elevated levels after a powerful rally throughout 2025 and early 2026. The market was full of optimism. Industrial demand was strong, especially from the renewable energy sector, and many investors were expecting looser monetary policy from the United States. All of this created a bullish environment where prices climbed rapidly. But markets don't move in one direction forever. When momentum becomes too strong, it often sets the stage for a correction. And in March 2026, that correction arrived with force. The first major factor behind this drop is the shift in expectations around U.S. monetary policy. At the beginning of the year, traders were confident that the Federal Reserve would begin cutting interest rates aggressively. Lower rates tend to support metals like silver because they reduce the opportunity cost of holding non-yielding assets. However, as new economic data came in, that narrative started to change. Inflation proved to be more persistent than expected, and economic activity remained relatively stable. This forced markets to reconsider the likelihood of rate cuts. Instead of expecting easier policy, investors began pricing in the possibility that rates would stay higher for longer. This shift had a direct impact on silver. Higher interest rates make assets like bonds more attractive compared to silver. As a result, capital began flowing out of metals and into yield-generating investments. This created sustained selling pressure and pushed prices downward. At the same time, the U.S. dollar began to strengthen. This is another critical factor. Silver is priced in dollars, so when the dollar rises, silver becomes more expensive for international buyers. This reduces global demand and adds further downward pressure on prices. During March, the dollar's strength acted like a headwind that silver could not overcome. Now let's talk about market positioning and profit-taking, which played a huge role in accelerating the decline. After such a strong rally, many institutional investors were sitting on significant profits. When the market showed signs of weakness, these players began to exit their positions. This is a normal behavior, but because of the scale of their trades, it can move the market dramatically. As prices started to fall, stop-loss orders were triggered across the market. Leveraged traders were forced to liquidate positions, adding fuel to the sell-off. This created a cascade effect. Prices dropped faster, panic increased, and more selling followed. This is why the decline felt so sharp and relentless. Now here's something that confused many traders. Despite ongoing geopolitical tensions and global uncertainty, silver did not behave like a safe haven asset. In theory, uncertainty should push precious metals higher. But silver is different from gold. It has a dual role. It is both a precious metal and an industrial metal. This means that its price is influenced not only by fear and uncertainty, but also by expectations about economic growth. When investors begin to worry about a slowdown in global manufacturing or reduced demand from industries like electronics and solar energy, silver can decline even in uncertain times. This dual nature makes silver more volatile and sometimes unpredictable. Another important aspect of this drop is the technical breakdown in the market. There were key levels that traders were watching closely. One of the most important was the $80 level. When silver broke below the support, it sent a strong bearish signal. Technical traders and algorithmic systems reacted immediately. Selling pressure increased and the market quickly moved toward lower levels. As the price continued to fall, it broke additional support zones around 75 and 70. Each breakdown reinforced the bearish momentum. Eventually, silver reached the mid-60s, a level that had not been seen for some time. Now the big question is, what happens next? To answer this, we need to look at the current market structure. Right now, silver appears to be stabilizing after the sharp decline. Prices are moving within a range, and volatility remains high. This kind of behavior is typical after a major move. The market is trying to find a new balance between buyers and sellers. The key support zone is now between $65 and $70. This is where buyers have started to step in and prevent further declines. If this level holds, it could indicate that the market is forming a base. On the other hand, resistance is clearly defined between $75 and $80. This zone was previously a strong support area, and now it has turned into resistance. For silver to regain bullish momentum, it needs to break above this level and hold there. So we are currently in a range-bound environment, and the next move will depend on which side breaks first. Let's explore the possible scenarios. In a bullish scenario, several factors could support a recovery in silver prices. If economic data begins to show signs of slowing growth, the Federal Reserve may shift its stance and signal future rate cuts. This would weaken the US dollar and make silver more attractive to investors. Additionally, industrial demand for silver remains strong in the long term. The transition toward renewable energy, especially solar power, continues to drive demand for silver. This fundamental support could help the market recover over time. If buyers gain control and push prices above $80, it could signal the start of a new upward trend. In that case, we could see silver targeting higher levels once again. However, the bearish scenario is equally important to consider. If the US dollar continues to strengthen and interest rates remain elevated, silver could face further pressure. A break below the 65 level would be a significant bearish signal. It could open the door for prices to move toward $60 or even lower. There's also the risk of weakening global demand. If economic conditions deteriorate and industrial activity slows down, demand for silver could decline. This would add another layer of pressure on the market. For traders, this is a critical moment. The market is not clearly trending. It is in a transitional phase where both bullish and bearish forces are competing. This creates opportunities, but it also increases risk. In such an environment, discipline and risk management become extremely important. Instead of trying to predict the exact direction, traders should focus on key levels and price action. Watching how the market reacts around support and resistance can provide valuable insights. A strong breakout in either direction could signal the next major move. It is also important to understand the role of sentiment. After such a sharp decline, market sentiment becomes fragile. Many traders are cautious, and confidence takes time to rebuild. This can lead to increased volatility, as even small pieces of news can trigger large price movements. Looking ahead, several factors will influence the direction of the silver market. These include U.S. inflation data, Federal Reserve policy decisions, movements in the U.S. dollar, and global economic conditions. These macroeconomic drivers will likely determine whether silver recovers or continues to decline. So what should traders take away from all of this? First, understand that this drop, while significant, is not unusual in the context of commodity markets. Corrections are a natural part of any trend. Even in strong bull markets, sharp pullbacks can occur. Second, recognize that the market is currently at a decision point. The next move could be significant, and it will likely be driven by macroeconomic developments rather than just technical factors. Third, focus on risk management. In a volatile market, protecting capital is just as important as making profits. And finally, stay informed. The silver market is highly sensitive to changes in economic data and policy expectations. Keeping up with these developments can give you an edge. Right now, silver is in a phase of uncertainty. It is not clearly bullish or bearish. It is waiting for a catalyst that will determine its next direction. But one thing is certain. After the biggest drop in 10 years, the next major move in silver could be just as powerful. And for traders who are prepared, this could be one of the most important opportunities of 2026.